Well, the trade war impact is, I guess, a little uncertain. Our own sense is that the first phase of that, the 50 billion tariffs on both sides, really have almost no impact on either volumes or pricing capacity. In reality, most of the component parts that go from China to the US will continue to get shipped because the supply chain is difficult to move in the short term. And most of the commodities that are coming into China continue to come in, albeit through alternative supply chain mechanisms. So you're not seeing too much in that. The second phase of the tariffs, or if it continues to get ratcheted up, is a little more uncertain. Now, that could be plus or minus to a place like Singapore, because as supply chains shift around, countries like us sometimes actually benefit with parts of the supply chain moving to other parts of Southeast Asia, for example, could actually be good news. On the other hand, it could result in a reduction in the total volumes of trade, which obviously would not be very helpful. The bigger challenge is really the psychological challenge. I think this refers back to where I started. The fact that people are more uncertain about where this is going creates a degree of lower confidence. And that results in, whether it's the credit spreads, in the stock markets, in animal spirits in the region coming off. Yeah. And obviously some of our business is related to those animal spirits. Unfortunately, there's not too much you can do about that, and so you have to go with the cycles on that one.
Thankfully, I mean, the cycle seems to be on your side, or on the side of financials generally, with in a rising interest rate environment. I want to talk to you about, partly as a consequence of U.S.-China trade, the tensions escalating. People are starting to talk about it as a war now, as they trade tariffs, throw them at each other, as it were, is strong dollar, which has resulted in almost globally tighter liquidity as well as higher funding costs. How has that been affecting DBS?
Interestingly, Martin, we're not seeing the tighter liquidity in the region. So there is no paucity of dollars. And in fact, in a strange way, because there's no tighter liquidity, we're not seeing the pricing go up on something like trade finance, as an example. It continues to be tight. Now, what does happen is funding cost goes up. But as long as your lending goes up in line with funding, then you're okay. By and large, banks do well in rising interest rate environments because our net interest margins increase. And as you can see in our performance in the second quarter, our overall funding costs on fixed deposits went up by 13 basis points, but our overall earnings on the loan side went up by 18 basis points. And that, frankly, is good news.
Hey everybody, it's Hadley Gamble from our new CNBC Middle East Bureau in Abu Dhabi. Thanks for stopping by. Now, to watch more, you can try one of the videos that just popped up on your screen. And don't forget to subscribe.